Our 50th anniversary gives us the opportunity to reflect, including on our environmental, social and governance or ESG efforts, which have very much been a part of our investment process since the inception of the company. During our time on the investment team, Nicole and I have learnt both from the portfolio managers and senior analysts, as well as through looking at reports dating right back to the early days of Allan Gray, that Allan Gray has a long history of standing up for its shareholders and therefore our clients' rights. While the methods to do so have changed as shareholder rights have evolved, the principles have always remained the same, and I think the overarching principle has been protecting our clients' interests.
Responsible investing has really grown in prominence over the past decade, but there is a lot of confusion about what exactly it means. It is actually an umbrella term encompassing 5 different approaches to investing. We have always focused on 2 of them: ESG integration in our research and engagement and action on our clients' behalf as the shareholders of the companies we invest in.
It's no secret that investment analysts love numbers, but the process of valuing investments is much more than a numbers game. If we take 2 mining companies as an example, both are trading on the same multiple of their free cash flow, in a net cash position, well positioned on their sector commodity cost curves. Which is the better buy? This question cannot be answered without further context. Among other things, we will consider factors such as which has a more favourable commodity basket. And within that, we think about the energy transition, for example, and how demand may shift for commodities within this transition. Issues like which company has a stronger management team, a very important part of what we do. Which operates in more stable jurisdictions, both geopolitically and socially. Which operates its mines more safely. And which mine is better managing its environmental liabilities and permits. All of these factors I've listed are in fact environmental, social, governance, ESG considerations, and they can have material impacts on companies' prospects, cash flows and valuations. We use a combination of quantitative analysis, so the number crunching that I spoke to, and qualitative analysis to form our assessments of companies. For example, when it comes to a management team, we would look at metrics such as operational and financial performance under their leadership, their capital allocation track record, as well as executive remuneration incentive structures and how well these are aligning management with long-term shareholders such as our clients. We also base our opinions on meetings that we hold with management, as well as getting third-party perspectives as an independent view. We believe ESG integration is critically important because it manages risk and improves returns. And the overarching effect is that it protects our clients' interests as shareholders. However, there are complexities with ESG evaluation. For example, people tend to view these issues through the lens of their personal value sets. And this is understandable because different issues resonate with different people. There are also trade-offs sometimes between environmental, social, governance and economic factors. So we try to assess these issues as holistically as possible and form a balanced view. Our primary job is to distill the ESG factors that are most material to the investment case and therefore that may impact the valuation, or consider the size of the position that we should hold in that company in our portfolio as a result of the risks. With that said, we do try to encourage companies to operate as ethically and honestly as possible and to manage their social and environmental impacts. Apart from it being the right thing to do, this also ensures longer-term sustainability for that company, which aligns with our clients' interests as long-term shareholders.
How we consider ESG in our investment philosophy has remained unchanged since 1973, but we strive for ongoing improvements in our research and processes. Our main objective has always been to preserve and grow our clients' wealth over the long term. As long-term shareholders, our clients benefit from corporate governance structures that yield positive decision-making. That is why a big focus, both now and in the past, has been on the key decision-makers, management and the board of directors, because they will be the ones who will ultimately drive that value preservation and growth. We closely scrutinize executive remuneration and engage with companies to improve the alignment between executive pay and shareholder outcomes. We want management to see themselves as shareholders alongside our clients and for their actions to reflect that. Our continued focus on executive remuneration is really because we have seen the value it can add at companies that have very well aligned remuneration structures. We also focus a great deal on having a strong board of directors in place to really act as the last line of defense against poor decision making. In our research, we try and be very mindful of the things that we don't know, and that's particularly true when it comes to the board of directors. We don't know what's happening inside of a boardroom, and that is why we rely on our engagements with directors and the outcomes under a particular board, under a particular committee, and that informs our voting recommendations to clients. Our actions over the years have varied. Different circumstances call for different actions to be taken. In the past, we have even pushed for the reconstitution of a board when the board and management have failed to unlock shareholder value for clients. We try and get the balance of views right. So during our engagements, we'll have the ESG analyst, investment analyst, and portfolio manager present to make sure we're not taking an isolated view on any one aspect. As Raine mentioned, we like to distill in the research phase the most material risks to the investment case, and that then goes on to shape what we may focus on during our engagements.
A lot has changed in 50 years. In fact, a lot has even changed in the past 3. Nicole and I often talk to how we credit company management teams and boards for showing remarkable resilience in what has been very tumultuous times. Since 2020, companies and individuals have navigated the COVID-19 pandemic, devastating floods and riots in KwaZulu-Natal, national load shedding and failing infrastructure, and also supply chain disruptions due to the Russia-Ukraine war. While some of these were unavoidable, it is also a sobering thought that the greatest ESG risks facing SA Inc. companies today are the consequences of avoidable government corruption and mismanagement. This is why, despite being bottom-up stock pickers, we ensure earnings diversification in our investment portfolios to manage this and other risks. Thank you for being clients of Allan Gray, and we will strive to keep serving as responsible stewards of your capital.